In the past, when individuals made contributions to charity, they receive a tax deduction for those contributions. But due to tax law changes, now 90% of U.S. taxpayers no longer receive a tax deduction for making contributions to charity, which has given rise to a new solution, which is something called a donor-advised fund. So in this video today, we're going to go through how these donor-advised funds work, how they operate, how you set them up, and who they may be a good fit for. The issue of taxpayers not being able to deduct their charitable contributions on their tax return first arose when they passed the Tax Cut and Jobs Act back in 2017. So when you file your taxes, you have to decide whether you're going to take the standard deduction or whether you're going to itemize. And usually you'll select whatever one gives you the largest deduction because it's subtracting from your overall taxable income. But when they passed the Tax Cut and Jobs Act, they greatly increased the amount of the standard deduction, but at the same time, they limited itemized deductions. And the reason why that's important is charitable contributions are itemized deductions. So if you're not itemizing, you don't receive a tax benefit. In 2024, the standard deduction for a single filer is $14,600. For someone who's married filing joint, the standard deduction is $29,200. So that's the amount you get to take off of your income before you reach your taxable income. In order for it to make sense for a taxpayer to itemize, they have to have deductions that are itemized deductions that are higher than those standard deduction amounts that I just mentioned. And the one thing the Tax Cut and Jobs Act cap were actually two of the largest itemized deductions that individuals had, which were property taxes and state income taxes. And they ended up capping the dollar amount of those two deductions at $10,000 combined, which means if you have, let's say, property taxes of $8,000, and then you have another $12,000 that you paid in state income tax, before they passed this tax bill, you could have taken a itemized deduction of like $20,000 just for that. But with the $10,000 cap, they say, hey, any amount over $10,000 for those two big combined items, the most you can get is $10,000. Let me show you how this works in an example. So let's say we've got Joe and Sarah who file a joint tax return. They pay state income tax of $8,000 and they pay property taxes of $6,000 and they donate $5,000 to their church and a variety of charities throughout the year. They can elect to either take the standard deduction for $29,200 or they can elect to itemize. However, if they itemize, their state income tax and property taxes total $14,000, but they're capped at the $10,000 SALT cap. The only other tax deduction that they could itemize is their $5,000 contribution to the church and charity, which would bring their total itemized deductions at $15,000, which is well below the $29,200 standard deduction. So they would end up foregoing the tax benefit of those charitable contributions and just electing the standard deduction. The key thing, again, to remember here is in order to capture the deduction for charitable contributions, you have to itemize. If you take the standard deduction, there is no tax benefit. And then I wanted to know the answer to the question, well, how many tax filers in the U.S. elect to take the standard deduction versus itemize? And in accordance with the Tax Policy Center in 2020, about 90% of taxpayers claimed the standard deduction. Prior to the passing of the Tax Cut and Jobs Act in 2017, only about 70% of taxpayers claimed the standard deduction, meaning that more taxpayers were able to itemize and take advantage of the tax deduction associated with those charitable contributions. One of the solutions that has become popular in response to this limitation of the deductions is establishing what's called a donor-advised fund, which allows taxpayers to make contributions to these donor-advised funds, potentially capture the tax deduction, and then distribute their amounts to charity from that donor-advised fund. But what is a donor-advised fund? A donor-advised fund actually looks on the outside a lot like a self-directed brokerage account that's just earmarked specifically for charitable contributions. You make contributions into this account, you get to self-direct the investments within the account grows, and then you tell the platform who and when and how much you want to distribute to various charitable organizations. But these donor-advised funds can't be sponsored by just anyone. They actually have to be set up by what's called a sponsoring organization, which in itself is a non-for-profit entity or 501c3. And the two most well-known out there right now are Vanguard and Fidelity. Now, while most people have heard of Vanguard and Fidelity, which are definitely for-profit investment platforms, they've actually carved out within themselves a non-for-profit organization for the sole purpose of sponsoring these donor-advised funds for investors. Now we're going to move on to why people contribute to these donor-advised funds and how it allows them to recapture the tax deduction, as well as how these funds operate. So starting with the why, it's really about grouping your charitable contributions into a single tax year so you can itemize. So instead of doing, let's say, $5,000 per year to charity for the next 10 years, instead you would do a $50,000 contribution to one of these donor-advised funds all in 1 year, which then qualifies for potentially a $50,000 tax deduction, which will now allow you to itemize in that year and capture the tax benefit. I'll show you an example of how this works. So let's say Tim and Linda typically give $5,000 per year to charity. Since they don't have any other meaningful tax deductions outside their property and state income taxes, which are capped at $10,000, they take the standard deduction of $29,200 when they file their tax return. By doing that, they do not receive any additional tax deduction for the $5,000 contribution that they made to charity because they don't itemize. Now, instead, let's say Tim and Linda establish a donor-advised fund at Fidelity and fund it with a one-time contribution of $50,000. Since they made the contribution to a donor-advised fund, which qualifies as an IRS-approved charitable organization, they will then be able to itemize when they file their taxes. They will be able to capture the full $50,000 tax deduction associated with their charitable contribution, plus potentially that $10,000 for the state and property taxes, which is far in excess of the $29,200 standard deduction. So that's how they're recapturing the tax benefit. But the good news with these accounts is even though you made a $50,000 contribution in 1 year to your big donor advised fund, you do not have to distribute all that money in that year to charity. It's allowed to go into the investments that you've selected within that donor advised fund, continue to grow, and then you get to decide each year how much you want to distribute to charities, which charities, your church, local charities, bigger charities. It's completely up to you. Each platform does operate slightly differently, so different platforms have different minimum grant requirements, meaning how much do you have to send out each year to a charity. I believe on the Fidelity platform, it's just $50 a year. That's it. So if you just want to do $200 or $100 to charity in that year, that's all you have to do, and the money can keep growing. Other platforms like Vanguard, I think theirs is every few years, you just have to distribute a certain dollar amount. So again, it varies from platform to platform. And as I just mentioned with the investments, not only is this money in this donor advised fund for your future charitable contributions, but you can also have it invested. When you set up this account, Vanguard or Fidelity say, hey, how you want to allocate this thing? You can do a 60% stock, 40% bond portfolio. So not only do you have the $50,000 to give, but if that makes money, there's no tax on the appreciation. It's more you're going to be able to give in the future directly to charity. Now let's transition over to how these donor advised funds actually operate. Contributions, distributions, fees, all that good stuff. I gave you some hints within that example, but the first we'll kind of talk about our minimum funding requirements. So again, different platforms, different rules. The Fidelity platform does not have any minimums. So you can begin a donor advised fund with pretty much any dollar amount, where I believe the Vanguard platform has a $20,000 minimum to establish a donor advised fund. The fees that the sponsoring organization charges can also vary from platform to platform. Now, at the time I'm filming this, I believe Vanguard and Fidelity are pretty close to each other fee-wise. It's roughly about 60 basis points or 0.6% that they charge against the account balance each year, which is their fee for maintaining their non-for-profit, which allows you to have that donor-advised funds, processing contributions, distribution statements, all that good stuff. Next item, how are distributions processed from your donor advised fund to your charity of choice? And it's actually very simple and straightforward. So you fund your donor advised fund. When you're ready to make a charitable contribution to a local organization, the Red Cross, your church, there's two ways you can do this. Usually you can either log into your account online and they'll have a pre-built list of many of the big non-for-profits out there that have already contracted with their platform. So you'll find them and say, hey, send Red Cross $1,000 right out of my donor advised fund. Or if they're not on the list, then you just provide the platform with all the information they require to issue the check to that non-for-profit. If people don't want to log in online, most of these platforms also allow you to call them and say, hey, this is the organization I'm looking to send this charitable donation to. The minimum annual grant funding requirement, as I mentioned previously, I looked it up. So Fidelity requires you do a minimum of $50 worth of grants each year. So you have to send at least $50 to a not-for-profit each year. Where on the Vanguard side, they require you to just make at least a $5,000 grant every 3 years. So you could do 0, 0, and then 500 in the third year. So you have a lot of flexibility as to when and the amounts that you send out of these accounts over your lifetime. Another very important note about contributions to these donor advised funds are they are irrevocable, which means you can't all of a sudden change your mind and take the money back, which kind of makes sense because if you contribute $30,000 to one of these things and they give you a tax deduction, you can't all of a sudden change your mind and say, no, I want the money back, but I'll keep the tax deduction. So once those contributions are made to the account, they can only be distributed to charity from there. Since some of our clients have substantial balances in some of these donor advised funds, we had to ask the question on their behalf of if the owner passes away, and there's a balance left in this donor advised fund, let's say $20,000, how does that work? And the platforms have communicated to us that there's really two options. So the first option is you can list almost like charities as beneficiaries like you would an IRA. So you pass and like this is how the balance is split up between 2, 3, 4 charities of your choosing. That's how the balance is distributed out. Or the second is you have what's considered successor owners of your donor advised fund. So whether it's your spouse and they take over ownership, or let's say you have 3 kids, they would then become the successor owners, but all that money still has to go to charity. Now, with a child scenario, we then asked the next question, which was, okay, if someone has 3 kids, and let's say there's $30,000 in this donor advised fund, so essentially $10,000 each, what if the kids have different charitable intents? They all don't go for the same charities that they want to make donations to. And one of the platforms basically said they're allowed to segregate that donor advised fund into separate accounts for each of the kids, and then they can give from the account that's in their specific share, but the amount still has to go to charity. Now, there is a huge additional tax benefit associated with what you use to fund your donor advised fund with. So you could either fund it with cash, which is simple and straightforward. Here's the 40 grand, put it in my donor advised fund, or you can gift appreciated securities like stock directly from your taxable brokerage account into one of these donor advised funds. And what it allows you to do is get credit for the fair market value of those securities for a tax deduction, but you also avoid having to pay tax in the unrealized gains associated with the securities that you use to fund that account. An example of donating an appreciated security to fund my donor advised fund, well, let's say I have just a regular Fidelity taxable brokerage account and I bought Apple a long time ago for $10,000 and now it's worth $80,000. So I have a $70,000 unrealized gain in that security that if I just sold it in my brokerage account, I'm going to have to probably realize long-term cap gains tax on that gain. But if instead of me selling it, I say, hey, I'm going to do an $80,000 contribution to this donor advised fund to capture that charitable deduction, I can just transfer that Apple stock over to my donor advised fund at Fidelity. So it's a separate account that I set up that's now this donor advised account. Now I capture the $80,000 charitable contribution deduction and I avoid having to pay tax on the unrealized appreciation on that security. There are annual limitations that you have to be aware of when it comes to being able to deduct charitable contributions when you itemize. And it does matter whether you make those charitable contributions to your donor advised fund in cash or whether you do it in appreciated security. Because if you do it in cash, the limitation is 60% of your AGI or adjusted gross income. If you decide to do it in appreciated securities, it drops to 30% of your AGI is what you can deduct towards your charitable contributions. Quick example, if your AGI is, let's say, $100,000 and you decide to give cash to your donor advised fund, you may be able to take a charitable deduction up to $60,000 or 60% for that year, versus if you gift appreciated securities, you may be able to only take a tax deduction worth $30,000 or 30% of your AGI. While establishing a donor advised fund may be a viable solution for recapturing those charitable deductions that were lost, it is by no means the right fit for everyone. Essentially, your charitable contributions and charitable intent have to be large enough to even justify establishing a donor advised fund for this strategy to work. If, for example, you're contributing $2,000 per year to charity, even if you total up your next 10 years worth of charitable contributions, which might be $20,000, that still might not be enough to justify establishing one of these donor advised funds, because if the standard deduction is $29,200 at a varied filing joint and you do $20,000 worth of charity, you need at least another $9,200 in other itemized deductions before you're going to get any benefit for doing that donor advised contribution in that tax year. Hurdle number 2 is you need the disposable cash or appreciated securities that you can transfer to actually fund this donor advised fund. We'll have people that say, yep, I do about $2,000, $3,000 a year, but I don't have $30,000 sitting aside that I can just put into this fund and commit it 100% for charity. What if I need it for something else? Then the donor advised fund might not be the right route. The third hurdle are the income limitations that I mentioned with AGI. So if I have a retiree who's only making $50,000 a year, if they did their max cash contribution to a donor advised fund, it's still limited to just $30,000, which is 60% of their AGI. If they did the appreciated securities, it's half that, $15,000. So again, do they have enough other itemized deductions to justify not taking the standard deduction? Dovetail on that, individuals that are already in a low bracket are not usually searching for additional $20,000, $30,000 tax deductions. Usually the taxpayers are in the upper brackets that are saying, hey, I'm trying to do whatever I can to lower my taxable income and tax liability. Those are usually the better fit for these donor advised funds. This strategy does work very well for individuals that are in abnormally high income years. Like we can have a business owner all of a sudden sell their business and be showing a few $1,000,000 worth of income, and they're looking for every tax deduction possible. And we'll sit down and say, well, if you're usually giving to charity $10,000 per year and you expect to continue on that path even after you sold the business, maybe you decide in this really high tax year to give $100,000 to this donor advised fund so you can capture this big tax deduction in a year that you really need it because your income's so high. The last topic we're going to cover is how to set up these donor advised funds. So in the description of this video below, I'm going to include the links to Fidelity and Vanguard's donor advised solution. You can go there. It takes you about 20 minutes to set up an account, decide how you want to allocate the account, and you're off and running. I hope this information was helpful. If you have any questions, please feel free to reach out to me at greenbushfinancial.com. Thank you.